Hello, this is Sean Taggy with Memphis Investment Properties. Today I'm thrilled to be talking with y'all about our pro forma and explaining what the numbers mean behind each thing on our pro forma. And what we try to do is make this pro forma pretty simple and laid out, but also thorough enough for you to understand the value of owning real estate and all the many benefits that that can come from real estate that a lot of people don't realize are in it. So here's a typical property that we have for sale here in Memphis that's available. And I'm going to just walk through each number and what it means for you. So here's the price, $109,000, and there's the monthly rent. And you also have, here's your monthly column and then your annual column. So first off is you collect rent, and unlike most other property management companies and turnkey companies, we actually do account for vacancy in our pro forma. So right here we show that there is a 4% vacancy. We came up with that number because that is actually our average vacancy right now. We manage 1,750 properties, and out of that right now about 4% of them are vacant. So that would be your rent collected after your vacancy. And so then we have our property management fees. Now property management fees are only charged on what is collected. So that would be 8% right here. So in our general assumptions you can kind of see everything we're charging for. So that would be 8% of the collected rent, so of the operating income. And then we have the property taxes, which are pulled right off the county record for city and Shelby County taxes. Then you have your insurance, and our insurance is a discounted group policy rate that we have from our insurance provider if you use us for your property management company. And then repairs. Repairs we have in here as 8%. Typically on a home built 1980 or before 1980, we'll put 8%. If it's built from 1980 to around, I believe, 2000, 2005, we'll put a 5% maintenance because it's a newer house. You're going to have less repairs. And a newer house, 2005 or newer, we put a 3% maintenance on there. So that's why you'll kind of see the maintenance change from one pro forma to the other. So there's our repairs right there, estimation for you to see. Sorry, right there, $88 a month. So there's your total operating expenses, $331. So this is where you come up with your net operating income. So that is your rent, so your income minus your vacancy and your expenses. You'd have $721 a month. Now, net operating income I like to show to people who are purchasing a property all cash. That's really the number you would look for. So if you're going to not have a loan on this property, that is everything you'll be collecting every month before you had a mortgage. So that's your NOI in other terms, which is your income minus your expenses. So then, most of our people though will use a mortgage. So we have mortgage payments, and how we calculate this is we just use a simple amortization calculator, and here's the metrics for the mortgage. Typically most of our investors are getting a 80% loan to value loan. Right now our interest rate's around 3.75. So there's your down payment and then some closing costs. So that's your initial cash invested and your total money you would need to put into the property if you were going to get a loan. So your net cash flow, that is for people who are getting a loan. That's how much money you'll have at the end of the month after paying your debt service and everything else and all expenses. So key investment indicators help our investors quickly analyze a property. Instead of having to look at all the expenses and everything and put all that in your head, we've just created these 5 numbers that can really help you quickly compare one property to another. So the rent to value ratio, that is the monthly rent divided by the purchase price. So right now that is at 1%. So the higher that number is, that means you have a higher rent compared to the sales price. The lower that number is, that means you have a lower rent compared to the sales price. Now that doesn't necessarily mean it's a bad purchase if that number is lower or higher, because that can be factored into other factors depending on the area, the class of the neighborhood. If there's more homeowners buying in that neighborhood, that means they're going to be overpaying than what an investor would for that property. So it's not necessarily all based on cash flow and your rent to value ratio. There's neighborhood factors, and you might have more appreciation in a neighborhood with with lots of homeowners compared to one where it's mostly all renters and investors. So it's kind of weighing your pros and cons of what you're looking to invest in. Your cap rate, so the cap rate is short for the capitalization rate, and that is if you bought the property all cash. So as I discussed above, cap rate is your net operating income, and it's the annual net operating income divided by the purchase price. So right there. So that is 7.9% for this particular property. The cash-on-cash return is if you bought the property with a loan. So it would be your net cash flow, so your annual net cash flow, and divide that by your initial cash invested, because that's the total money you're putting into the property. So your return on investment, cash in versus cash out. Okay? So that right there would be an awesome investment, just at 11% or even 7.9%. But this is what I love. This is what I love explaining to our investors about the other benefits of owning real estate that you don't actually realize, every year. The cash on cash is what people understand because, I got $2,761 into my pocket. But what other people don't realize, and what really helps people from getting discouraged, is that you're having so many other benefits in real estate. So now we've calculated our return on investment with principal reduction and tax savings. So we're assuming a loan here on an amortization table. So you have a loan amount of $87,600, but during the first year you're going to be making payments of $491 a month, and a little bit of that goes to principal and a little bit more goes to interest at the beginning. But over time that shifts to where at the end of that 30-year amortized loan, a lot of the payments are principal and a little bit are interest. So we're calculating this principal reduction just for the first year. So during the worst case, when principal isn't getting reduced a lot off the loan. So in order for you to understand that principal reduction, I actually have an amortization table right here. So with our loan amount of $87,600, during the first year, so your first 12 payments, you'll be paying around $4,600 in interest, but you will have paid down $1,207 in principal. So that's awesome. So that's factored in there on your return on your return on your equity, your return on your investment of that down payment plus closing costs. So looking at this, during the 10th year of this loan, so the first year you have $1,200 in principal reduction. During the 10th year, you're paying down $1,900. And this is where it gets interesting. 20 years from now, you're paying down $3,300 in your principal balance off the loan. And then the best part is the very last year, you're paying down $5,700 in principal. So as we can see, real estate just gets better and better the longer you own it. That's why we encourage most of our investors, actually all of our investors, depending on their strategy, to own these properties at least for a 5-10 year horizon. Really 30 years is optimal because that's when the mortgage is paid off and now you can start collecting way more because you have no mortgage to pay. So let me get back into our pro forma here. So that's that principal reduction for the first year, and then also the tax savings. So here's our tax savings assumption. We're assuming you're in a 33% tax bracket. You can adjust this for what bracket you're on. But another benefit of real estate is that the tax benefits, these are huge that people tend to look over and not even appreciate really. So what you can do, and I'm not an accountant, but please consult your accountant on this, on how to depreciate and write off the expenses. But we have the land value of $15,000, so we have total depreciable value. The total depreciable value is the land value minus the price, and you can have your accountant do that ratio for you. And so that's how much you can depreciate. Now you're going to depreciate this property 1/27 and a half. So over 27 and a half years, you can talk to your accountant on this, but the IRS allows you to do that, even though the property is appreciating. You can claim that as a deduction. Also, you can deduct all of your expenses, so $3,967. You can also depreciate the mortgage interest. So even though the mortgage interest is very high at the very beginning, you can write that off. And so your total tax deductions would be $12,000. Now if you were in a 33% tax bracket, essentially your net tax savings would be $4,000. So that is those numbers. This represents your annual cash flow plus that principal reduction of what I showed you, $1,200 I believe the first year, plus your net tax savings divided by your initial cash invested. right here. Okay, so that shows you in the first year your return on your equity when you really consider all that. Now this is on paper, you haven't sold the property or realized any of those gains, but that's what you have, and according to your net worth it would grow by that amount for this particular property. So what we did lastly is, we don't like to be speculative, but Memphis did appreciate about 5.4% in 2017. So we have appreciation now as this bottom number. So this number, first off, is pretty much a solid return of what you can do. Oh, I'm sorry, I messed up. So your ROI with principal reduction and tax savings is a little more guaranteed, right? That is something you're going to be able to depreciate it every year, and you're going to be paying down your mortgage every year. The ROI appreciation is just up to the market and how things happen. But if you factored in a 3% appreciation of $109,000 plus your principal reduction plus your tax savings plus your cash on cash, your net cash flow for the year, and divided by that by your initial cash invested, that would be what that number represents. So if you look at everything with a conservative appreciation and your tax write-offs and your principal reduction and your cash flow for the year, that's what your total return on investment would be. What an amazing return. I mean, really, that's something very hard to find anywhere else. You have to be a very good investor in other asset classes, where if you compare that to the stock market or any other company, it's something that you really can't control, right? Where this is a physical asset that you can control and you have insurance on. So if this asset burns down or anything like that, you have insurance on it and can claim that insurance on there, and you can write it off as a tax deduction if you do lose anything. So this, I just get really excited about showing our investors about the benefits of owning real estate, and really a lot of things that they don't see in the long run, that they aren't accounting for. And when I see someone discouraged after a year or 2 or 3, and maybe they have a rough year and have to replace something expensive on their property, just remember you have all these other benefits of taxes and appreciation of the mortgage pay down, and that real estate is really a long-term perspective of what you need to have on it. So yeah, that's Sean Taggy signing off. Feel free to reach out to me with any questions you have, and you can check out our website anytime. It's MIP, that's short for Memphis Investment Properties, so MIPinventory.com. Thank you very much and have a great day.